Jai Jagannath. Today's session relates to income computation and disclosure standards. In my last session, I told you Section 276 of Income Tax Act 2025, subsection 2 basically says methods of accounting depends upon income computation and disclosure standards declared or notified by central government from time to time. Now in this session, we will discuss about the income computation and disclosure standards. Point 1, these standards are notified by central government from time to time. Point 2, they may not necessarily be equal to the accounting standards issued by the Institute of Chartered Accountants of India. Why? See, there is a basic thing. Accounting standards issued by Institute of Chartered Accountants of India are meant to prepare the books of accounts of a company, and they should be prepared in such a manner that the stakeholders will not be affected. You should not show higher profit by not recognizing provision for losses or expenses, etc., because such higher profit may mislead a stakeholder or investor who want to invest, or maybe a banker who wants to give loan to you. But in case of income tax, what happens? The ultimate objective is to calculate the profit properly so that government can tax appropriate amount of tax. So ICDS basically suggests that provision for losses should not be made unless and until it is required by another ICDS, because they may result into lesser profit and lesser tax to the government exchequer. So the objective is very clear. Accounting standards protect the interest of the stakeholders, and ICDS protect the interest of the revenue. These are the basic two things that we should keep in our mind. There are around 10 ICDS notified by the central government as on today. In this session, I am going to analyze 3 ICDS: ICDS 1, ICDS 2 and ICDS 3. ICDS 1, disclosure of accounting policies; ICDS 2, valuation of inventories; ICDS 3, construction contract and revenue recognition. Clear? Now basic and fundamental knowledge of accounting is required to have a better understanding of these ICDS, because I will compare between ICDS and accounting standards. Okay. Now let me go to ICDS 1. Just like AS1, it says what are the 3 fundamental accounting assumptions. These are the going concern, consistency and accrual. Going concern means the accounts under consideration are related to a business which is not going to be liquidated in the near future. If it is going to be liquidated in the near future, then the fact should be disclosed. So I am assuming that it is not going to be liquidated in the near future, therefore it is a going concern business. So whatever accounting or whatever profit is calculated, it is related to a continuing business. That means a business which is not going to be discontinued in the near future. Then consistency. Accounting policies should be consistently followed on a year-to-year basis. That means what accounting policies I have followed in the last year, it is assumed that I am following in the current year, and it is expected that I will continue to follow them in the future year. In last session, under section 276 of Income Tax Act 2025, I told you that मैंने आपको बोला था इसके बारे में कि there should not be change in methods of accounting on a year-to-year basis. Okay, these are strictly prohibited. Okay, then accrual. Normally, it is assumed that the accounts are prepared or maintained under accrual or mercantile basis unless and until it is specifically disclosed that they are followed under cash basis. But we have to keep in our mind, ICDS is applied only when we have prepared the accounts under accrual basis. So these are the 3 fundamental accounting assumptions. Last session I told you, you can follow either cash or accrual method. Hybrid method is not at all allowed. If you want to change from cash to accrual or accrual to cash, it is generally not permitted. but change in accounting policy are allowed only under reasonable causes under ICDS 1. Okay, can I change the accounting standard, accounting policies? As per accounting standard, I can change the accounting policies under 3 grounds. Condition 1, for better presentation of financial statement. Condition 2, to meet the requirements of statutes. And condition 3, to meet the requirements of the pronouncements of the Institute of Chartered Accountants of India. But ICDS says you can change the accounting policy only if you have reasonable cause to change them. Unless and until you prove that you have reasonable cause. For example, there is a requirement of statute, there is a change requirement as per the ICDS or as per the Income Tax Act provisions, then you can change. Otherwise, without reasonable ground, you cannot change the accounting policies. What are accounting policies? Accounting policies are specific accounting principles and methods of applying those principles. So, they should be consistently followed unless and until there is a reasonable ground to change them. This is the requirement of ICDS. Then my friends, let us go to what factors I should consider while selecting an accounting policies. For example, method of depreciation, method of inventory valuation. Whenever there are 2 or more methods available, in order to select one method, I have to take into consideration the following factors. As per accounting standard, these are materiality, prudence and substance over form. Materiality means only if the item is of significant amount, significant value, it will be considered, unless and until it is recurring in nature. Prudence means recognize all losses but do not recognize gain unless and until they are realized. Conservative system. Substance over form means substance of the transaction is more important than its legal form. Legally you may be the owner, but if I am occupying the house for more than 12 years, or if I am occupying a machine or plant for more than a specific period of time covering almost all the life of the plant and machinery, then I will be deemed as the owner of the property even if legally it is registered in your name. Substance over form. Now what ICDS says? ICDS ignores materiality. It says irrespective of the size of the amount, you will recognize all amounts or all items if they are going to affect the income. You have to disclose all items if they are going to affect the income. So recognition or disclosure will be based upon the effect on income, not on materiality. Point 1. Very, very important. Always remember it. Materiality discarded. This says if an item, irrespective of its size, is going to impact the income, it should be disclosed. Then come to prudence. Prudence says recognition of all losses. That means you will make a provision for losses or expenses. Conditions, accounting standard 29. What are the conditions? Obligatory event, reliable accounting, estimation, probable cash outflow. Then you can recognize the provisions. But ICDS 1 says you can recognize provision for losses or liability because they are going to impact the income and tax accordingly. You will take undue benefit of provisioning. Therefore, ICDS says provisioning can be made only if it is required by another ICDS. If there is no specific requirement by another ICDS, provisioning is strictly prohibited. Clear? Part 2 is over. Substance over form, same. Okay, that means legal ownership is not enough. Substance of the transaction is more important than the legality of the transaction. Clear? Ho gaya? Then 2 impacts we have discussed. One is relating to materiality, second is relating to provisioning, and third part what I am saying, change in accounting policies only under reasonable causes. Only under reasonable causes. Whatever conditions accounting standard 2 says, that is what accounting standard 1 says, That is one, requirement of statute, 2, pronouncement of ICI, 3, better presentation of financial statement. These are not there in ICDS 2. They are specifically given in accounting standard, but they are not under ICDS 1. Clear? Now let me go to ICDS 2. ICDS 2 is related to inventory, valuation of inventory. Now, as you know, accounting standard 2 deals with valuation of inventories. How the inventories are valued? They are valued at cost or net realizable value, whichever is less. ICDS 2 also recognize recognition of inventory at cost or net realizable value, whichever is less. Point 2. It is very, very important. Standard cost or retail price method can be adopted for measuring the cost where cost cannot be identified under any other method as per AS2. ICDS 2 also says you can apply standard cost or retail price method provided they resemble the actual cost of the inventory. ऐसा नहीं है कि कम वैल्यू दिखाने के लिए आप स्टैंडर्ड कॉस्ट और रिटेल प्राइस मेथड को अडॉप्ट कर लोगे. They can be adopted provided they resemble the actual cost. Point 3, that is very, very important. In case of dissolution of firm, अगर firm dissolve हो रहा है and business is continued, accounting standard says you will recognize the inventory at cost. Basically at cost or net realizable value, whichever is less. But ICDS specifically says, ICDS 2 specifically says, in such circumstance, you will recognize the inventory at net realizable value, even if it is more than the cost. So it may result into notional profit and higher tax payment. So if you are going to dissolve your firm, for example, one of the partner retired or terminated, but other partners try to continue the business or want to continue the business, it is a dissolution but continuation of the business. Here inventory need to be revalued and the revaluation should be made at the net realizable value as per the requirement of ICDS 2. So there may be result into higher profit and payment of taxes. That is very, very important. Next important thing, how to calculate the cost or net realizable value, whichever is less, whether it is for the whole set of inventories or categorize. Categorize wise, you have to identify what is the cost of the inventory, what is the NRV, and whichever is less you have to take into consideration. Not for the whole inventories. Categorize wise, you have to identify it. You can change the method of valuation of inventory provided there is a reasonable cause. जैसे कि मैंने आपको already बता दिया है. Whatever adjustments you are making to the inventory cost, they must be properly disclosed in clause 13 of form 3CD. Here you must keep in your mind, आपको दिमाग में रखना पड़ेगा, ICDS is required in case of tax audit and proper disclosure in clause 13 is very, very essential. If you are not properly disclosing it, then tax audit is not appropriate. So while making tax audit in 2026, we have to keep this thing in your mind. Another important thing, accounting standard 2 does not specifically say valuation of inventory in case of service contracts or service work contract, but ICDS specifically says how to make valuation of service work contract. You can make a valuation of service work contract by taking into consideration amount involved in payment of labor charges or other charges. So service contracts and service inventory can be valued under ICDS 2 even if there is no specific provision under accounting standard 2. Then finally comes the interest. As per accounting standard 2, if the inventory what you are producing or manufacturing within your own organization takes substantial period of time for completion, then borrowing cost like interest, financial charges may form part of the cost of the inventory. But there is no specific mentioning in the ICDS 2. It says that borrowing cost will form part provided it is there in ICDS 9. So ICDS 9 relates to borrowing cost. We will have a detailed discussion on ICDS 9 when we will go to the ICDS 9. This is all about accounting standard 2. So ICDS 2. So I have completed ICDS 1 and I have completed ICDS 2. Now my dear friends, there is a request, please like, subscribe my channel, this YouTube channel, to get the latest update. I am not a money seeker, I am not making these videos for making money. Even if monetized, that is not my wish. I am just making videos for the benefit of the students, because knowledge spreading is my passion. Whatever knowledge I have, I want to distribute it among the needs, as for the need of the people. So like and subscribe so that I will be motivated to deliver more and more videos, and also press the bell button so that you will get the notification as and when I will upload a new video. Please like and subscribe. Now come to ICDS 3. ICDS 3 relates to construction contracts. What is construction contracts? For example, builders constructing houses, builders constructing apartments, या फिर road contracts taken by the government contractors. These are all coming under what? Works contract. ये सब works contract के purview में आ रहा है. Now how to make revenue recognition for works contract? Very simple, percentage completion method. That means on the basis of completion of the project, you will recognize the revenue. Suppose total contract value is 100 crores, 40% is completed, so 40 crores will be recognized as revenue, and if the cost associated with this 40% completion is 35 crores, then 35 crores will be deducted, and on 5 crores you have to pay the profit. You have to pay the taxes. That is very clear. Now second thing, very important again, unless and until the project is completed 25% or more, they have given a threshold limit. If the project is completed 25%, then only recognition of revenue will start. That means up to 25% completion, government assumes that there is no reasonable certainty regarding the completion of the project or receipt of the revenue. So you may not recognize the revenue. So in this case, what happens? Up to 25% completion, revenue is equal to cost, no need to pay the tax. But once 25% is completed, you will recognize the revenue on the basis of percentage completion. As I said, 100 crores is the total revenue receivable. 40% of the project is completed, recognize revenue 40 crores. Okay, suppose you have received 50 crores, you have already received 50 crores from the customer. In that case, 10 crore will be recognized as advance from customers, 40 crore will be recognized as revenue. Suppose the cost involved in completion of 40% is 38 crores, then on 2 crores you will pay tax. आपको टैक्स देना पड़ेगा. Suppose the customer has paid only the 30 crores, but the revenue to be recognized is 40 crores. Then receivable from customer will be shown as 10 crores. But you have to pay tax on 40 crores minus 38 crores, 2 crores. Suppose the tax rate is 30%, on 2 crores you will pay tax of 30%, that is 60 lakhs. आपको tax देना पड़ेगा. So even if you have not received the money, if you are following actual basis of accounting, you have to compulsorily follow ICDS 3. Construction contracts, and you have to pay the tax even if amount is not received by you. Clear? It is very simple. Now suppose you have received some retention money, you need not refund it. Even if it is not yet received, you have to take it into consideration while calculating the profit. Profit calculate के वक्त आपको उसको consideration में लेना पड़ेगा. Next important thing related to construction contract. All costs which are directly attributable to the contract, whether they are expended before the starting of the contract or after the starting of the contract, they will be added to the cost of the contract. So the only condition is that all costs which are directly attributable to the contract. If the costs are not directly attributable to the contract, they need not form part of the cost of the contract. That is very important. Suppose you have received some advance money, or you have taken a loan and the amount is not utilized, you have deposited it in a bank and you are receiving interest, or you are receiving any financial benefit from that, then as per accounting standard 7 or 9, okay, they will be deducted from the cost of the project. But ICDS 3 specifically says these will be taxable under the head income from other sources. Clear? So any financial gain that you are getting before the initiation of the project or starting of the project, all such financial gain will be taxable under the head income from other sources. Now if there is some losses associated with the contract, जो भी contract आप carry on कर रहे हो, if there are some losses associated with those contracts, those losses will be recognized only under actual basis. That means you cannot, जैसे कि मैंने आपको already बताया कि ICDS do not recognize provisioning. So provision for losses you cannot make. All losses will be recognized only on actual basis. All borrowing cost associated with the contract will be dealt as per ICDS 9, which specifically deals with what? Borrowing cost. Clear? Retention money, I already told you, retention money will be taxable irrespective of the fact whether it is received or whether it is not received. So these are the basic issues relating to what? Construction contracts. So let me summarize ICDS 3 again. 1. If 25% or more of the project is completed, you have to recognize revenue under percentage completion method. Point 1. All costs attributable to the project will form part of the cost of the contract, whether they are incurred pre or post. Retention money will be taxable whether it is received or whether it is not received. Any financial benefit you are getting during the project will be taxable under the head income from other sources. They will not be deducted from the cost of the project. In a recent High Court judgment, the Honorable Court has given a different judgment, but I am not going to that. Okay, this is as per the requirement of ICDS. Clear? All borrowing cost or interest cost will be dealt as per ICDS 9. There is no specific provision under ICDS 3. This is all about construction contracts. Inventory, as I already told you, cost or market value, whichever is less. You can take standard cost or retail price method provided they resemble the actual cost of the inventory. Okay. In case of dissolution of the firm and continuation of the business, the inventory will be valued at net realizable value. That is very, very important. It is not there in accounting standard 2. So there may be notional profit, and on that you have to pay the taxes. Change in valuation of inventory is permitted provided there is reasonable ground, there is reasonable cause. Borrowing cost as per ICDS 9. Okay. Similarly, materiality is not recognized under ICDS 1. That means if any thing is going to impact the income, it should be recognized or disclosed irrespective of its size. Concept of prudence, provisioning is not permitted unless and until it is required by another ICDS. Clear? So please keep these facts into consideration while making tax audit under Income Tax Act 2025. If you have any doubt, then you can WhatsApp me 94374 33425. Please like and subscribe my YouTube channel for getting these videos. These are awareness programs for your benefits. Thank you. Jai Jagannath.